Hi, everyone. I'm Lindsay Hosfield, and welcome to our Young Timers Ask the Expert series. Today, we're talking to Aaron Eisenach about long-term care planning and insurance. Aaron has been working in long-term care services since 1996. He is a long-term care specialist and broker helping people across the U.S. with their planning needs. He is also an educator certified by the state of Colorado as a provider for continuing education classes and is one of the most sought after informative speakers on long-term care in the U.S. Aaron, thank you so much for joining us today.
It's my pleasure.
Let's jump right in. So can you just explain for us what long-term care officially is? Because I know there's different stages of the disease, right? There's like preclinical Alzheimer's disease where you're not symptomatic, but you know you have the mutation. And then there's, you're symptomatic, but you can still work. And then you're symptomatic and you can still do a lot of things. And then you kind of progress. So when does long-term care kind of come into the picture?
The best way to inform the audience as to how you can collect long-term care insurance benefits is to go through an exercise. First of all, there's two different ways to trigger a policy, and this is nationwide. Okay, this is promulgated by the government back in 1996. A bill called Kennedy-Kassebaum codified how it is that long-term care insurance policies for every company has the same methods of approving benefits. Number one, cognitive impairment. That's our Alzheimer's, our dementia trigger. Mm-hmm. So when someone needs substantial supervision of another person, and if that person has a long-term care insurance policy, they should be able to start collecting benefits. Mm-hmm. The other trigger is this. When you woke up this morning and you opened your eyes, the first thing you did next was you got out of bed. That is called a transfer. We're transferring out of the bed or the recliner into, say, a wheelchair or something like that. The second thing a person would likely do after getting out of bed is use the restroom. If you can't use the restroom safely without falling or requiring another person being there to catch you, that is what we call an activity of daily living.
Okay.
So there's 6 of them. Mm-hmm. So we talked about transferring. Mm-hmm. We talked about toileting, mm-hmm. on and off the toilet. Maybe then you take a bath or a shower if you need help doing that. That's the third one. Perhaps next, you got dressed. If you need help getting dressed, that is an activity of daily living. Then we might go down to the kitchen and have breakfast. If you can't feed yourself, that is another trigger. And the last one is, can you maintain continence? If you can't maintain that hygiene, maybe you need Depends or something like that. Mm-hmm. Okay. That is the 6th one. Okay. So either we have something like Alzheimer's disease or another form of dementia causing a lot of supervision, or someone has had a major stroke or an accident. We can go on claim because we need assistance in 2 or more of those 6 activities of daily living.
2 or more.
And it must be expected to last 90 days or longer. Okay. So when we're looking at any long-term care insurance policy in the nation, that's how you can go on to claim and then start getting benefits.
Okay. And you mentioned this briefly, but can you talk about what types of care and facilities will actually cover a person's long-term care needs?
Let's start with an assisted living facility.
Okay.
Because a lot of assisted living facilities now are specializing in memory care, correct?
Okay. Mm-hmm.
So if someone is in the assisted living facility and they have a long-term care insurance policy, the assisted living fees to live there should be covered by the long-term care policy as well as the care services. Of course, people can move into an assisted living facility without needing any assistance at all. But if they have long-term care insurance and they start to need care and they have that coverage, now that policy is going to pay up to a monthly maximum benefit. It could cover 100% of the cost of care. It could provide less than that as well. Nursing homes are usually the last stop. And with a nursing home, normally they're going to be in there. And if they have any sort of long-term care insurance, it's going to pay because they need that either supervision 24/7, or they are in such a situation where they have to need, a lot of care. So some people in assisted living are not yet receiving benefits because they don't yet qualify. But people in nursing homes, if they have a policy, they should be able to collect benefits. In years past, there were policies that only covered nursing homes. Then they started to add home care as a benefit. And then they added assisted living. Today, almost all policies offered in the country are what we call comprehensive policies. They cover home care, assisted living, nursing home, hospice, and adult daycare.
So my next question is just kind of giving us an idea of what the financial landscape is that comes into play when somebody is diagnosed with Alzheimer's disease. I mean, we don't have to talk about all of it because in another series we'll get into Social Security and long-term disability and all of those things, but we do hear about those things. And so I was just wondering, if somebody doesn't have long-term care insurance, let's say at the time of their diagnosis, how could they pay for long-term care?
Well, that's a great question. And it's a puzzle, right? I mean, if they don't have any form of long-term care insurance, hopefully they're wealthy on their own, but that's usually not the case, right? Especially if we're talking about people with early onset. They probably haven't worked long enough to amass a fortune to pay for care. Okay, so what do? Well, there is a SSDI, Social Security, SSI, I should say.
Okay.
That is for people that are older than 65 and older. There can be a benefit that I wrote it down here. Let's see. It's not large. I wrote down $794 for this year. Okay. If it's Social Security Disability Insurance, or SSDI, the average this year is $1,277, and the maximum someone could get is about $3,200, and that depends on how long a person has worked. Okay, so another problem with relying on those programs, they usually will deny your application the first time, just out of hand, because they're inundated, and we don't really have the money to take care of all these folks. So they usually just say the first time you apply, you're declined. You apply again, and you might get some benefit. But we're talking about just small monthly amounts.
Another option, and I'm aware of this because this is something that my family had to do, was what you call a Medicare or Medicaid spend down, right?
Correct. Yes.
Can you kind of explain what that is?
Yes, I'm no expert in it. It is a bit of a cottage industry where we are basically saying we've got some money and we know that we're going to need care. Our loved one is going to need care. We're going to try to put everything that we can into a Medicaid trust, if you will. Okay. And if care happens, we better make sure that it's 5 years into the future, because there is a penalty period if you try to get benefits before 5 years are up. When I started in long-term care insurance in 1996, it was a 3-year look-back period, and now it's a 5-year look-back period. Let's use a single person as an example, because it's much more simple and easier to comprehend. That person could have a home it can't be worth, in most states, more than about $850,000 in equity. If they have a $1 million home, they can't get Medicaid. They would have to basically sell the home and then use the proceeds to pay for care privately. So we can have a home, we can have a car, we can have $2,000 in the bank.
Not
That
much.
means a lot of things are gone.
Right.
Now we can also keep our furnishings in the house. You can have an irrevocable burial plan. You can have your wedding ring set. But for the most part, you're trying to be impoverished on purpose in order to be able to get the government program called Medicaid to help out. And even if someone is on Medicaid, if they are still getting income, the income needs to be used to pay for care as well. So there's a lot of rules. It requires an attorney that knows what he or she is doing, of course. Something that, and I'm in Colorado, and something that we are really experiencing here is that the facilities that take primarily people on Medicaid versus self-pay, the facilities that are Medicaid primarily usually have a substandard care service. And I'm trying to be careful on how I say this, but in a way you get what you pay for.
Right. Okay.
Right. And like you said earlier, Lindsay, everyone wants to be at home. That is number one for most people.
Well, I mean, the purpose of this interview, I mean, we walked through kind of the situation of what happens when somebody's diagnosed and what their options are, and if they don't have long-term care insurance. But our goal is to inform people early on so that they can have their planning set ahead so that they can stay at home or, be able to pay for whatever care that they want to have. So let's get into that portion now. So when do you believe is the best time to apply for long-term care insurance? Is it prior to contacting a genetic counselor, an early onset familial Alzheimer's disease? We all pretty much know that we're at risk, but we probably don't know whether we have the mutation or not. Is it prior to receiving the genetic test? Should it be a certain number of years before a parent's age of onset? I just like your insight and understanding when we should apply.
Well, the best time to buy any form of insurance, whether it's homeowners or auto or life, health, the best time to buy is today, because you never know what could happen tomorrow. But to be more precise here in an answer, you listed, is it before we have the genetic test? Is it before we've even talked to a geneticist? The answer is yes. Okay. We want to do this before there's any trace, if you will, of the possibility that this company that they might be trying to apply to looks at this situation. Oftentimes it will be an application that is submitted, and on the application it might say, physician, who are your specialists? And it could be that discloses that you've talked to a geneticist. You want to do all of your planning, in my opinion, before you mess around looking at, do I have the gene?
I get asked this question a lot as well. Like, how do you go about finding the right long-term care insurance agent? Because you're probably, let's say, in your 20s, 30s, it's maybe uncommon for an agent to see somebody so young getting a policy. Some people talk about, reaching out to friends and family because they kind of understand the situation. If somebody doesn't have a friend or family member in this business, like, what is the best way to go about finding an insurance agent that could help them?
My bias is to be able to represent many companies and many different types of solutions. So there are plenty of agents in the nation that specialize in long-term care planning. Okay. And how do you find them? There are some databases. There's an organization called the American Association for Long-Term Care Insurance. And then there's also one called the CLTC, Certified in Long-Term Care Corporation.
Is there a way to tell, I got this question from somebody, is there a way to tell if an agent is working for you versus one that's working for a commission? Is it having to do with, again, are they independent brokers?
There's some misconception out there, and that is this. The agent actually works for the insurance company, not the client. And that's true everywhere. Now, an agent is going to kick and scream and scratch to get a policy written, right? But when it comes down to the legalese, I am an agent for the insurance companies, but I'm still going to, like any other good agent would do, I'm going to do everything I can to help that person get what we want. And I don't know that there's any way that you could buy a policy that does not include commission to the agent.
I mean, a lot of people, again, and for good reason, may be hesitant to disclose their situation to an agent, you know? There's a balance, right? That they think in sharing enough information to get the appropriate products versus being discreet enough to not present yourself as being totally uninsurable, right?
Sure.
And so what would you recommend? Let's say there's a 35-year-old person, their father died from early onset familial Alzheimer's disease. They don't know their genetic status. Would you disclose, you know, that situation to the long-term care insurance agent?
Yes.
Okay.
Because we want to make sure that the companies that we are evaluating for coverage will not just reject someone out of hand versus companies that will say something like this. If one parent had Alzheimer's disease, we can still apply. You're going to have a memory exam, but there are plenty of companies that say, yes, even though it's early onset, you don't have any symptoms, you're free to apply. Just the other day, I talked to a company, it's a life insurance company. So what we were looking at is using the death benefit from the life insurance policy to fund long-term care. Okay. And an underwriter told me over the phone that, oh yes, it's fine. I looked at the application and all it said in there basically concerning Alzheimer's disease is that how do I put this the right way? On the application, it said concerning Alzheimer's, have you had medical advice regarding Alzheimer's? Okay, so she hadn't had medical advice, but she knows that she has a 50-50 chance of having the gene. So the underwriter said, I think it's just fine.
Okay.
Well, I checked with a second underwriter with the same company, and she said, no, absolutely not. You cannot apply. Okay. So we want to be forthcoming when we're talking to an agent, because the agent needs to have that professionalism and the ability to finesse this. Right. We don't want to commit fraud. Right. I'll never do that for a person. Right. But when we've got companies who say, yeah, even if it's early onset and it was just one parent, you don't know that you have the gene, we're still going to test your memory, you can get the coverage. So forthcoming is very important. It's like you're kind of on their team and you can play, different scenarios by knowing that information, right? Exactly. And you wouldn't be able to do that if you didn't know. Yeah. Yes. And of course, if we know that the person has the gene, the mutation, we can't do anything. Okay. So now that, we've kind of talked about
talking to an agent, I think it's important just to say that this shouldn't replace, talking to an agent and exploring all the different options that people have, because everybody's going to be in a different situation, even with early onset familial Alzheimer's disease. Some have an onset in their 40s, some have it in their 60s. And I think obviously different products would benefit those two different types of people. So what I'm curious, if you can just give us an overview of like, what are all of the products that are out there, just so that people are aware of what they can start thinking about, and maybe what are some advantages and disadvantages in your mind when you have an early onset, let's say, background.
Well, there are basically 5 different types of long-term care products on the market today. Okay, the first one we're going to call traditional long-term care insurance. We call it traditional because it's been around for about 40 years. And traditionally, that's what we always offered and sold. Okay. Mm-hmm. Traditional long-term care insurance policies are basically health insurance policies that pay for chronic illnesses, whether it's Alzheimer's, major stroke, accident, you name it, living long enough to be feeble and frail. Okay. So they do one thing: pay for care. If you cancel the policy, you get nothing back. If you die without using it, you get nothing back. So it's pure insurance, if you will. That's the first type. The second type is a life insurance policy that allows the death benefit to be used over time if care is needed. So say someone bought a $300,000 whole life policy or universal life policy, what we call permanent policies. If care is needed, and again, we're going back to the same benefit triggers that we talked about before.
Right.
That policy might say you can get, for example, 4% of the death benefit each month until it's gone. And if there's anything left when the person passes away, the remaining death benefit goes to beneficiaries. I'm going to introduce a concept called reimbursement versus cash indemnity. There are policies that pay benefits in the form of cash, and there are others that reimburse you up to your monthly benefit if care is needed. I think this is really important to understand when it comes to early onset, because a policy that is called reimbursement requires that you have to have a home care agency providing the care. If it's a spouse, a sibling, a parent doing it, it doesn't pay. The policy won't pay. Policies that pay benefits in the form of cash indemnity say that here's your monthly benefit that you qualify for, and you can basically use that money for care from anyone. And if there's leftover money, you can use the leftover money for anything, as long as the plan of care allows for it. So I bought a policy at age 30, and it's a reimbursement policy. 5 years later, I bought a second policy. You can have more than one policy. My second policy pays benefits in cash indemnity. So if my wife is my caregiver, my daughter, my son, a robot someday, the cash indemnity is going to be really nice to have. Okay, so when we talk about life insurance policies, there are a number of them that allow you to use the death benefit in the form of cash indemnity. The third type, we're blending together the first two concepts. We have a little bit of life insurance and a little bit of long-term care insurance in one package. We call that linked benefit. When we think about the traditional long-term care insurance policies, no death benefit, no money back if you cancel. And with traditional policies, there can be increasing premiums over time. When we introduce a life insurance component, then we can guarantee premiums. We can give money back if you cancel or if you die. So the linked benefit products are the Cadillac today or the Tesla. Okay? They're more expensive. Also, with the linked benefit policies, we usually pay premiums for a set number of years, say 10 years or to age 65.
Okay.
And then we don't have to pay premiums any longer. The fourth type of coverage is probably not something that people with early onset will need to worry so much about. It's using an annuity to pay for care. Mm-hmm. We throw, say, $100,000 into an annuity, and if care is needed, the annuity pays benefits for care and until it's gone. If it's never used up, it becomes a death benefit. If care is needed, there is a long-term care insurance rider that continues to pay for care. Again, that's probably not for people that are in their 30s, 40s, 50s. Those are usually for people in their 70s or so.
Okay.
The last one, number 5, short-term care insurance. Policies that pay for about 300 days or 360 days of care services. It's always better to have some coverage rather than no coverage at all. These policies are easier to qualify for with your health. Mm-hmm. Of course, if there's any signs of dementia, we can't insure it. Okay. But with one of these policies, a person could probably pay $50 a month mm-hmm. for such a plan. Okay. And again, some coverage is better than no coverage at all. In Colorado, especially in assisted living facilities, we're hearing that people are taking their loved ones to tour some assisted living facilities, and they are telling the administrator, yeah, mom or dad already qualifies for Medicaid. And the assisted living facility operator might say this, well, you need to be able to self-fund the cost of the first or even second year of care out of pocket before we will even think of giving you a Medicaid bed. So that's called rationing. And I'm afraid that it's going to really start ramping up. So even if a person has a 1-year policy, that could be a ticket to getting into a Medicaid bed.
Okay.
Does that make sense?
Yeah. So just to give people an idea of like, what can I be expecting to pay as a premium for some of these products? Because I think you said $50, but I imagine some of these other more expensive premiums could be quite a bit more.
Well, first of all, it's going to depend mostly on age and health. Let's just do a quick example of a life insurance policy. Let's use that $300,000 death benefit, as I mentioned. Okay. Let's say that we're insuring someone that's around 35 or 40 years of age. Okay. If he or she is in good health, might be able to pay around probably about $300 per month. And if care is needed, there's $300,000 to help pay for care. In fact, it's probably going to be more like $250 a month for a plan like that. If we're talking about traditional long-term care insurance policies, those premiums have really gone up. So for people with early onset, I think life insurance can be a really neat thing. If we know it's early onset, we're not living to 80, 90, 100 years of age. We're looking at what? Maybe between the ages of 30 and maybe like 66. We've got this planning corridor, and that helps us out because most of the time people are buying life insurance policies that are purposed for the death benefit. Here we're purposing it for long-term care planning. The people that have a good amount of income, they might go to the linked benefit. So sometimes a person that might be in their 30s or 40s, they might need to pay anywhere between $500 to $1,000 a month for 10 years, after which time the policy is paid up.
So I think along those lines too, is there a way to calculate the projected cost of long-term care? I mean, how does it that I'm sure state to state it varies. I live in California. My mom lives in Colorado. I know that there's definitely a monthly difference in what an assisted living facility costs. But is there a way, I mean, especially in early onset, I feel like you can very much base it on your parents' disease, right? You can kind of see how long do I have to pay into this, right? Because you can look at the age of onset. Then you can also look at, well, how long were they at home? How long were they in a facility? And kind of calculate then, okay, if they were in a facility for 2 years, and a facility costs, let's say $6,000 a month, then I need this amount. Is there a place to go to kind of get an idea or estimate what people should be projecting to pay and getting a policy that covers?
I think the best tool out there is from an insurance company called Genworth.
Okay.
And we would provide you a link with that.
Yeah, I can definitely do that.
You could just go online and Google Genworth cost of care. And they have the median costs for every good-sized city in the United States. They also look at the cost of care beginning in 2004 versus now 2020. So you can look at the inflation of the care services. You can look at the median costs for homemaker services, assisted living, nursing home, hospice, all that kind of stuff. So it's all right there.
There's a lot of technical terms, I think, that also come into play when you're talking about a long-term care policy. Like when you're applying for a policy, that can also affect the cost as well. So you have a benefit period, there's an elimination period, there's an inflation protection. So can you just give us kind of a general definition or clarify what these terms are and what we maybe should expect would be good numbers for these types of things?
Right. And I'm going to use traditional long-term care insurance to answer your question. There are 4 major components or decisions you make in order to develop a policy. That is, how much monthly benefit might we afford? $5,000, $6,000, $10,000 per month. So that's number 1. Number 2 is how long these benefits might last. As you referred to, say 3 years, 4 years, 5 years. Even policies that last as long as the person lives. The benefit period is usually going to be around 3 to 5 years. And I think about this when it comes to the diagnosis of Alzheimer's. They say, and you'd probably know more about this than me, Lindsay, they say that from diagnosis, someone is expected to last 4 to 8 years before passing. Usually, we don't get that diagnosis until something is very apparently wrong. That doesn't mean that they're going to be able to go on claim right away because we have to have substantial supervision. Maybe somewhere, and I say that because you would say then, well, it should be 4 to 8 years in benefit period. Well, I think maybe 3 to 5 is going to take care of the bulk of it. The third component is inflation protection. Mm-hmm. We want these benefits to grow over time because we know the cost of care will grow over time. So you can have your benefits growing at 3% annually or 4% or 5% annually. Mm-hmm. The higher that inflation protection number, the higher the premium, of course. There's another way to look at it and say, well, why don't I just buy the highest monthly benefit I can get? And that's typically $10,000. And I think one company goes up to $12,000 monthly benefits, and just forget inflation. Okay, so we want to front end or front load the policy and just forget the inflation rider. Number 4 is the elimination period. This is how long you need to show that you've received care or you would qualify for care before the benefits kick in. There's 2 types of elimination periods. One says you have to show receipts for covered care services. You need that home care agency to come in and provide care and send in the receipts. The most common elimination period is 90 days. So if a policy is structured with a 90-day elimination period, that person must be able to show dates of services of 90 days before benefits can kick in. You could also have a 0-day elimination period. You could have a 30-day, a 60-day. You could have a 1-year elimination period. Okay. So there's a lot of choices there. 90 is usually the choice. That doesn't mean it's the right thing. There's also a rider that says if you need care at home first, the elimination period is waived and benefits begin right away. Okay, so there's two elimination periods. One where you have to show care services. It has to be from an agency. The other one is called calendar days. You don't have to show that you received care services. Your spouse or partner or whomever it is can be the caregiver. We just have to wait 90 days and then benefits can begin. Okay, so those are the four core design components of a traditional long-term care insurance policy.
We touched on this a little bit, but I just want to clarify. Once a person has a policy, can they expect to pay the same monthly payments until they need care? And again, you touched on this. In some policies, they maintain the same payments and some increase. Can you just clarify that again for everyone?
For traditional long-term care insurance policies, premiums are not guaranteed, with one exception, and that is there's at least two companies in the marketplace that say we will allow you to pay premiums for 10 years and then you are paid up. You never have to pay again. During the first 10 years of premium payments, they could have a premium increase, but it's not likely. The long-term care insurance policies that we call traditional, they are susceptible to rate increases. Okay. The life-based solutions and the annuity solutions have lots of guarantees, including guaranteed premiums.
That's good to know. All right, this is my last question. Is there any final advice you'd like to give individuals who are thinking about long-term care and planning?
Well, one thing that I think is important to bring up is the use of disability income insurance. I have long-term care insurance, I have life insurance, and I have disability income insurance. My disability policy is attached basically to my earnings. I have a pretty nice disability policy. So it's probably going to be what pays first if I need care.
You talked about that elimination period, right?
We still have that elimination period, and in my case, it's 90 days. But if someone is shopping for disability income insurance, it doesn't have to be that. You can make it 0 days. But my disability policy will probably pay first because it springs into action if I can't do my job. My long-term care insurance policy would kick in second. And at some point, they would probably be paying simultaneously. So I think disability income insurance is very important. It's not cheap. If you are in a hazardous occupation, the premiums go up. But that's probably something that we need to keep in mind with planning.
Okay.
And you asked me to, comment here, what else do I want to say?
Yeah.
Don't procrastinate. You can't win by procrastinating. Get on it. You will feel better if you can get some coverage under your belt. You can have more than one policy, as I said. So you might start with something that you can afford today, and then maybe in 5 or 10 years, if you're making more money and you're still healthy, grab another policy. That's what I did. Okay. Having some coverage is always, always better than having no coverage at all.
Right. I really, really appreciate, Aaron, you taking the time to walk us through all of these complexities. I think it'll be really beneficial to our community to have this resource moving forward. So thank you so much.
Yes, and if I can help any of your listeners, I would just be glad to help or point them to someone who can.
All right. Yeah, we'll provide your information, your contact information in this video so that they can reach out to you.
Okay.
Thank you.